Very good morning, student. Welcome to second lecture of Econ 242, that is Agriculture, Finance and Cooperation. Today our topic is about credit or loan. Credit need in agriculture, what is meaning, definition of credit, and most importantly, we have to discuss about the classification of credit based on different criteria. Okay, now we will see one by one. First one is meaning. As we know, credit means, or the word credit comes from the Latin word credo, which means I believe. From where credit comes? Credit, the word comes from the Latin language, which means the I believe. Latin word credo, credo means I believe. Hence, credit is based up on a belief, confidence, trust and faith. So as we know, credit is otherwise called as the loan. So this is the meaning of credit. Now definition. Credit or loan is a certain amount of money provided for certain purpose on certain conditions with some interest which can be repaid sooner or later. This is a definition of credit. Means credit or loan is a certain amount of money provided for certain purpose on certain conditions with some interest which can be repaid sooner or later. Now another definition of credit according to Galbraith, credit is the temporary transfer of asset from one who has to other who has not. What is according to Galbraith? What is credit? Credit is the temporary transfer of assets from one who has to other who has not. Okay, these are the two definitions of credit. Now we have to discuss about the credit need in agricultural sector or in agriculture sector. Okay, credit means loan, which comes from the word credo, Latin word credo, which means the I believe. Now we have to discuss about the credit needs in the agriculture. Okay, as we know, for agriculture sector there is a need of credit or there is a need of financial support for purchasing the inputs or for marketing. Okay, now we have to see what is the need of credit in agriculture. Agriculture credit is one of the most crucial input in all agricultural development programs. For example, for a long time the major source of agriculture credit was private money lenders. Means in old era or in past days, only money lenders are the source of credit for the agricultural farmers or for the farmers, but this source of credit was not inadequate, or that source is not sufficient, highly expensive and exploitative. Okay, so means there was no rules and regulation to them, that's why it is highly exploitative. Okay, to curtail this or to overcome this problem, a multi-agency approach consisting of cooperatives, commercial banks and regional rural bank credit has been adopted to provide cheaper, timely and adequate credit to the farmers. Means to overcome such a malpractices by the money lenders, government has decided or government has started the multi-agency approach, which consists of cooperative sector, commercial bank, regional rural bank, which has been adopted to provide, means these policies or these sectors or this approach is adopted by government to provide the cheaper, timely, adequate credit to the farmers. Okay, now the financial requirement of the Indian farmers are for why farmers need the credit, means to buy agricultural inputs like seeds, fertilizers, plant protection chemicals, means insecticide, pesticides, growth regulators are there, then feed and fodder for the cattle, etc. Then second, supporting their families in those years when the crops has not been good, means for livelihood or to sustain or to live, supporting their families in those years where they have not received any output from the crop. Okay. Then third, buying additional land to make improvement on existing land, to clear old debts and to purchase costly agricultural machinery. These are the needs of credit, why farmers needed the credit. Then credit is also needed for increasing the farm efficiency against limited resources, or for hiring of irrigation water, lifting devices, labor and machinery. So there are different purposes to take a loan by the farmer. Now we have to discuss about the classification of credit. There are different criteria, or credit is basically classified based on various criteria. First criteria, credit is classified based on purpose. Second, based on time. Third, based on security. Fourth, based on liquidity. Fifth, based on activity orientation. Sixth, based on approach, and last, contact with direct farmer. These are the different criteria on which credit is classified. First one, based on purpose. So based on purpose, credit is classified as a production purpose loans, marketing purpose loans, and the consumption purpose loans. Okay. Now second, based on time. Based on time, credit is classified as short term loans, medium term loans, and long term loans. Now third most important, based on security. Based on security, credit is classified as secured loans and unsecured loans. Another, personal security, collateral security, chattel loans. Then based on hypothecation, key loans and open loans. Based on mortgage, simple mortgage, equitable mortgage. Okay, these are the secured loans. Then based on the liquidity, self liquidating loans, partially liquidating loans. Then based on activity orientation, there are credit is needed for different activities like orchard loan, tractor loan, dairy farm loan, poultry farm loan, etc. Now credit based on the approach, individual approach, area approach, and DIR loans. Okay. Last, contact with farmers, direct contact and indirect contact. So this is all about the classification of credit based on various or different criteria. Now we have to see detail about these criteria. First, based on the purpose. So based on purpose, credit is classified as production, marketing, consumption. So in that first one, production loans. So production loans are indebited or intended to increase the production of the crops, or production loans are taken for the purpose of increasing the production of crops. Then these are also called as seasonal agricultural operations, or these loans are taken for the SAO. SAO means seasonal agricultural operations. Then loans or short term loans or the crop loans, or production loans, otherwise known as the crop loans, short term loans, or SAOs. In fill in the blanks, they may ask dash loans are called as the SAOs, seasonal agriculture operations loans. Okay. So these loans are repayable within a period ranging from 6 months to 18 months in a lump sum. Means repayment period of this production loan is 6 months to the 18 months in lump sum, or in a one installment. Okay. Now next, marketing loans. So these loans are taken for helping the farmer to overcome distress sale and to market the produce in a better way. Okay. Then regulated market as well as commercial banks based on the warehouse receipt. That warehouse receipt means warrant, as we have learned in last course of agricultural marketing. Warehouse receipt are extending financial assistance to the farmer in this regard, and they are advancing, means commercial banks, they are advancing up to 75% value of the produce. Commercial banks advancing the loan to the farmer up to the 75% value of produce which are stored in that storage on a security of the warrant or warehouse receipt. Okay, so this enables or this helps farmer to clear up their loans and dispose the produce at remunerative prices. So in a marketing also there is need of the loan. And last, based on purpose, that is consumption loans. Consumption loans, any loans advanced for the purpose of other than production, is broadly categorized as a consumption loan. Means the loans which are taken, which are used other than production purposes, they are considered as the consumption loans. Okay. It appears to be unproductive loan, means it looks like it is unproductive loan, but in fact indirectly they helps in productive use of crop loans and investment loans, averting to a greater extent the diversion of loans or to the other purposes. But it is not taken for production purposes, but it is taken for the consumption purposes. So these are the three types of loans based on purpose: production, marketing and consumption. Now next, these consumption loans are not very widely advanced and restricted to those areas which are hit by natural calamities. Means in case of natural calamities we need a loan, so we can take the consumption loan. These loans are granted on a group guarantee basis with a maximum of 3 members. Okay. The loan is to be repaid within 5 crop seasons, means 2.5 years, whichever is less. Means within 5 crop seasons, means 5 seasons or 2.5 years, whichever is less. The branch manager are vested with the discretion of sanctioning these loans up to 500 in each individual case. Means they are granted up to the 500 in each individual case. Now second criteria, classification of credit based on time. As we know, based on time, loan is classified as short term, medium term and long term. So this classification is based on the repayment period of the loan component. Okay, based on time means when we will repay the loan, within how much time we will repay the loan. So short term loan, these loans are to be paid back within a period of 6 to 18 months. Keep in mind the period of short term, medium term and long term loan. So first, short term loan has to be paid back within a period of 6 to 18 months. 6 to 18 months. All crop loans are said to be short term loans, but the length of repayment period to vary according to the duration of the crop. Means the length of repayment may be vary according to the duration of crops, because duration of some crop is 90 days, 120 days, 140 days, likewise. Okay, the farmer require this type of short term loan to meet the expenses for ongoing agricultural operations like sowing, fertilizer application, okay, intercultural operations, plant protection measures or payment to laborers, etc. These are the uses of short term loans. Then he is supposed to repay the loan from the sale of proceeds of the crops raised. Means he is bounded to repay the loan when he will get the after the harvesting or when he will get the output from that crop. Okay, this is about the short term loans. Now second, medium term loans. The duration of short term loan was 6 to 18 months. Here these loans are expected or extended for a period varying from 15 months to 5 years. means repayment has to be done within 15 months to 5 years. Duration of medium term loan 15 months to 5 years. Okay, these loans are required by the farmer for bringing about some improvement on his farm business, for reconstruction of or for development of farm. They need the medium term loans. These loans are way of purchasing implements, means these loans are required for purchasing the implements like electrical motors, milch cattle, sheep, goat, etc. Okay, then the relatively longer repayment of these loans is due to partial liquidating nature. So medium term loans are partially liquidating in nature. So medium term loans are required for the purpose to purchase the farm implements, some new technological or new machineries is there. For cattle, purchase of the new cattle like cows, milch cows, buffaloes, sheep, goat. Okay, now next is long term loans. These loans fall due for repayment over a long time ranging from 5 years to more than 20 years. Always keep in mind the duration of short term loan, medium term loan and long term loan. Duration of short term loan is 6 to 18 months. Duration of medium term loan is 15 months to 5 years. Duration of long term loan is 5 years to more than 20 years. Now long term loans together with medium term loan are called as investment loans or term loans. It may be asked for your fill in the blanks or MCQ or multiple objective type questions, which loans are togetherly known as the term loans or investment loans. So keep in mind, medium term loan and long term loan togetherly known as the investment loan or the term loan. Okay, these loans are meant for bringing about the permanent improvement on the land. Okay, like leveling, reclamation of the soil, construction of farm building, purchase of tractor or raising the orchard. Means purpose to take the long term loan is that for the improvement, permanent improvement in the land, for digging the wells, for taking the bore well. Okay, leveling of the land, reclamation of soil, construction of farm building, or to purchase the new farm implements or like tractor, permanent implements like tractor, raising of orchard, etc. Since these activities require large capital, a longer period is required to repay this loan by the farmer from additional returns obtained from these investment activities. Okay, so this is the classification of credit based on time. Now most important, classification of credit based on the security. Based on security, the loan transactions between lender and borrower are basically governed by the confidence in the borrower. The question of security may not rise at all in advancing loans, but this assumption is confined to private lendings or private lendings to certain extent, and institutional agencies do have their own procedure formalities in a credit transaction. Okay, hence imperative to classify the loan under this category into subcategories, that is secured loan and unsecured loan. So based on security, loans are categorized as secured and the unsecured. Now what is secured loans? So secured loans advance against some security by borrower, or borrower means who takes the loans. Loans advance against some security by a borrower are termed as the secured loans. So there are various forms or types of securities offered in obtaining loan, which are as follows. In a types of security, first personal security, collateral security, chattel loans, then fourth one mortgage. In mortgage, there are simple mortgage and equitable mortgage. In hypothecation, there is key loans and the open loans. Now, we'll see one by one different forms of security in secured loan. First one, personal security, means borrower, the person who takes loan, means borrower himself stand as a guarantor. It is advanced on a farmer's promissory note. Third party guarantee may or may not be insisted upon. There is no need, it may be needed or not needed of third party, means borrower himself act as a guarantor, that is a personal security. Second, collateral security. Collateral means it is the property that is pledged to secure a loan, means pledge means that is kept against the loan. The collateral security means the property that is pledged to secure a loan. The movable properties of the individual are offered as a security. Keep in mind, in collateral security, the movable properties of individual are offered as a security. For example, LIC bond, fixed deposit bonds, warehouse receipt, jewelry, machinery, livestock, etc. These are the movable properties are act as a collateral security. These are the some properties accepted as a collateral security by institutional or by banking sector. Okay, collateral security means security on movable properties like LIC bond, FDs, warehouse receipt, jewelries, machineries, livestock, movable properties. Now, next is chattel loans or chattel loans. These are specific type of loans with particular category of lenders, means borrower means the person who takes loan, or lender means the person who provides loan. Okay, loans obtained from pawnbrokers by pledging movable properties such as jewelry, utensils made of various metals, etc. are the example. In chattel loan also movable properties, but like a jewelry or utensils. Okay. Now, based on the mortgage as against collateral security, immovable properties are presented for a security purpose. In collateral, we have seen the movable properties like LIC bond, jewelry, etc. But in mortgage, here the immovable properties are presented for a security purpose, or they are pledged. For example, land, farm buildings, etc. Now, basically there are two types of mortgages, that is simple mortgage, equitable mortgage. So, simple mortgage is done by the banking institution when the borrower's property is inherited from the ancestors. Okay. Then in this process, the farmer means borrower has to register his property in the name of banking institution as a security for the loan obtained. Okay. This process entails registration charges to be borne by the farmer or to be paid by the farmer. So this is a simple mortgage. Okay. Second, equitable mortgage. This applies to self-acquired property. Equitable mortgage applies to self-acquired property. In this case, there is no such a registration because the ownership rights are clearly specified in the title deeds in the name of the borrowers or the farmer borrowers. Hence, documents will be obtained from the borrower as a security by the institutional agency. So, this is about the simple mortgage and equitable mortgage on the immovable properties. Now, next is hypothecation. So, hypothecation happens in the case of tractor loans, machinery loans, etc. Keep in mind the examples of hypothecations. Hypothecation happens in the case of the tractor loans, machinery loans, etc. Under such a loans, the borrower will not have any right to sell his machinery until the loan is cleared off. means until the clear up of whole loan, that borrower or that owner of machinery cannot sell his property or cannot sell his machine. The borrower is allowed to use purchase machinery or equipment so as to enable him to repay the loan in installments regularly. So, hypothecated loans are further categorized into two types, key loans and the open loans. So, in hypothecation there are two subtypes, key loans and open loans. So, what is key loans? The agricultural produce of the farmer borrower will be kept under the control of lending institutions. Lending institutions means those institutions who are providing the loan, and the loan is advanced to the farmer. Means the agricultural produce of the farmer is kept as a security by the lending institution. So that is a key loans. As and when the loan is repaid, the produce will be handed over to farmer. Okay, when that farmer will repay the loan, the produce will be handed over or given to the farmer. Such facility prevents the farmer from resorting to distress sale. Okay, this is about key loan. Now open loan. This is another name for hypothecated loans to which the physical possession of the purchased machines in the hands of borrower, but legal ownership remains in the hands of the lending institution till the loan is cleared. And last is unsecured loans, means based on security, that is secured, unsecured. So based on confidence between the borrower and lender, the loan transaction takes place. Means there is no security, there is no mention of any type of security in unsecured loans. Means that is a unsecured loans which are taken in a personal relation basis. Now next is classification of credit based on the liquidity. Under this type of classification, the loans are classified into self-liquidating loans and partially liquidating loans or non-liquidating loans. Now what is self-liquidating loans? The income generated through these loans helps the farmer to repay entire loan amount in the same season or year of obtaining loan, that is self-liquidating loan. Means the income generated from the loan will help to farmer to repay the loan in a single installment or after the finish of season of that particular year. The productivity increases of the loan is direct, in this case example short term loan or crop loan. Means if I have taken a loan in a Rabi season and I am able to clear this loan at the end of Rabi season, so these loans are known as the self-liquidating loans. Okay. Then partially liquidating loans or non-liquidating loans. The income generated through these borrowings or through these loans will help to pay part of loan of the loan component only. What happens in self-liquidating loans? The income generated through these loans will help to repay the entire loan amount in self-liquidating, but in partial liquidating, the part of loan amount we have to repay. In other words, these loans are cleared over a time period by the farmer or borrower. Means these loans are cleared in a different parts or different installments. These loans required relatively long time for realization of benefit, for example term loans. Okay, so this is about the based on liquidity. Self-liquidating loans means repayment of loan in a one installment. Partial liquidating loans means repayment of the loans in a small installments. Okay, self-liquidating loan example crop loan or short term loan. Partial liquidating loan example is term loans, means medium term or long term loans. Now last, based on the activity orientation. So there is no other basis except the activities for which the loan is advanced by the institutional agencies. It is more general type of classification, means activity based loans. For example, loan for sericulture, loan for apiculture, loan for piggery, etc. Okay. Similarly, tractor loans, dairy loans, orchard loans, land development loans can be cited under this category, means loan taken or loan borrowed for different activities, that is classification of credit or loan based on the activity orientation. Now last, based on the area. Now under this we have categorized the three, that is individual approach, area approach and DIR loans. In individual approach, this is advancing loan by the lending agency to a potential borrower for the purpose of his needs. Example, CI loans, dairy loans, etc. Means CI means crop loans, dairy loans, etc. That is individual approach. Next, area approach. Here loans are advanced by the selecting the contiguous area by the branch. Service area approach followed by the bank, it is an example. Service area approach, that is area approach. And next is DIR loans. Loans are advanced to the weaker sections of community at an interest rate of 4% per annum, that is DIR loans. So rate of interest of DIR loans are 4%. It may be asked in the fill in the blanks. DIR loans are advanced at dash dash percent interest rate. So our answer will be 4% interest rate. Last, based on contact with farmer, means classification of credit based on the contact with farmer. So based on contact with farmer, institutional agencies, they categorize these loans in direct loans and indirect loans. These are advanced directly to the farmer by the institutional agencies. For example, short term loans, term loans, etc. Means when institutional agencies have a direct contact, they advance the loan. Indirect loans, the institutional agencies directly do not finance the farmer but indirectly benefit the farmer by financing enterprises, different activities like financing fertilizer manufacturer companies, financing construction of warehouse and market yard, etc. So this is all about the classification of credit based on the different criteria. For this course, you can refer the book Agriculture Finance and Management by Subba Reddy, Raghu, and another book is Agriculture Economics by Subba Reddy, Raghu. Okay, thank you.